Hi everyone, welcome to IGNOU's classroom. In this video, we'll be discussing on the important questions and answers from MMPC 14, that is Financial Management paper, which is the semester 2 paper in IGNOU's MBA new syllabus. And in this video, we'll be focusing on the important questions and its answers from Unit 5. Let's get started. The first question is, why is the cost of capital considered very significant in financial decision making? Before we get into the question, let us do a quick analysis or a quick summary of what exactly is being spoken of in this Unit 5. Unit 5 deals with the cost of capital. This is from the block 2 where we are talking about all the different, the financial decisions, not the financial decisions, sorry, the investment related decisions that a financial manager or a finance function will be taking care of. Like for example, this entire block, you can think of it as all the concepts are related to the cost of capital, the investment appraisal process, which is another name for capital budgeting, then the working capital, the details of regarding the working capital and such. So in this unit, we are talking about the cost of capital. So as we all know, for a business firm to function or for setting up of any business firm or maintenance of it, we need capital, right? And generally the capital for a finance for a business can be derived from basically or broadly speaking two sources. One is the equity sources and the other is the sources of debt. So equity is our own sources. You can think of equity as own funds. Okay, so they may be the funds that we are bringing into the business from our own pockets, or maybe sourced from our friends or relatives, or if it is an existing business, then we can issue IPOs, we can go public and trade in the stock market, and from there we can raise equity capital, right? So they are own funds, that is what you can say owned by the company. It is the company's own funds, and it represents a percentage of ownership of that company based on the amount of equity that we hold. So that is equity capital. Then we have debt capital, which is, you can think of it as the borrowed money, which we get by borrowing that particular amount of money from different people. It could be in financial institutions like banks, or it could be from any other investors, maybe venture capitalists and such, right? So those are debts or borrowed capital. So equity capital, the only obligation, and that too is not a compulsory thing, is that we be able to pay back the owners of these equity holders some amount of dividend, right? That is the only thing. If the company needs the earnings, the profits for future investments, then they can completely retain it and not give any dividend at all. But in case the company suffers a loss, then the equity owners will also get affected. So it is like, what you can think of is that you are not liable to pay anything. Okay, and the people who have invested in the equity, they have done it by being fully aware that any loss to the business would lead to a loss in their investment as well, right? But in the case of debts, they come with a cost, and that cost is generally the interest rate. Okay, so that is the interest rate. So the cost of capital, what it means is that it is, you can think of it as the amount of money or the cost that the business is having to incur for holding that particular capital. Now thinking about this, you would think that having your funds entirely out of equity is the best thing to have happened in the for the company, right? It is, in one way it is definitely a good thing for the company, but the thing is that even though we don't have to give any interest rate as say per se on the equity capital, these earnings, the equity capital, they are eligible for tax, right? So if you are not giving any dividends, including dividends, all the profit that you earn, all the profits that a company earn, the earnings of the company, you have to give tax for that. So that is also again a cost that is associated with that equity capital. Whereas debts or any sort of loans, whatever interest you are paying, and those are tax deductible, they do not come up in your net profit after tax, right? So that is an advantage of this debt capital. So based on all these different calculations, these taxation policies, the legal policies, and all these different things, companies have to come up with the perfect capital mixture. That is called the capital structure. And capital structure is yet again another separate unit in our subject. But anyways, so that is the cost of capital, the cost that is associated with these different types of capitals. So let us come to the question, why is it considered very significant in financial decision making? Well, the cost of capital, as it provides the very basis for financial appraisal of a new capital expenditure proposal, it serves as the acceptance criteria for capital expenditure projects, right? So suppose if we are starting a new project, okay, let's say you are a company that manufactures mobile phones, you are the owner of that, and you are going to maybe start a new product, okay, maybe you are going to get into the earphone manufacturing business for these mobile phones as well, let us assume. Then how would that new project will need funding? It will need you can say it will need employees, it will need machines, it will need raw materials, it will need its own production line, electricity cost, water cost, all the different costs will come, right? Now, it might even need a particular plant to be set up, so then it will require land, building, machinery, or equipments, and that equipments might need maintenance, supplies like maybe oils or some coolants and stuff like that. Many things, right? So now all these things, if you have to purchase or lend or hire, whatever way we are going to, what you can say, bring in these things into our business, you will need capital. Now, how will we source this capital? Should we borrow the loan? Should we borrow the entire amount from the loan? Should we use our complete retained earnings and put it over here? How will we do it? Should we issue any preference shares or debentures, whatever? Okay, whatever has to be done. Should we issue any bonds to raise money in order to fund this new project? So all these things we have to calculate, or we have to decide as finance managers, based on assessing what cost does all these capital sources come from. Like for example, if you are sourcing from a bank, then it will come with an interest rate. If banks are not willing to pay you, you might have to go to the venture capitalists, and they might or maybe angel investors, and they might ask you to pay maybe 30 or 40% interest rate, maybe even 50, or they might even ask a particular amount of stake or a particular percentage of stake in your company. We never know. Have you on when you're talking, have you heard of this show called Shark Tank? It is a very good show, and it what happens in that show actually is that people come and pitch in their new business ideas over there, okay, and they tell these venture capitalists, there'll be a set of venture capitalists, 3 4 people would be sitting there. They will listen to those ideas, business ideas that you have, and you'll have to present with them all the financials, the forecasts, the business analysis, the environmental analysis, and everything that you have done. And you'll have to also tell them that your idea might be you have already started executing it, and then how, if that is the case, then what are the expected profits or the realized earnings that you have had so far, what is your operating model, what is your investment model, all these different things you might have to tell. And then finally, they will say, if they like the idea, then they might come in and say, okay, I will give you 30% of your required capital, but I need a 20% stake in your company, and things like that. So what they are saying is that they are giving you some capital, and the stake they are asking, or the interest rate they are asking you to pay them back, is the cost that is associated with that capital. Okay, that is what you have to understand here. Cost of capital, it helps the managers to determine the optimal capital structure of the firm. The cost of capital serves as the basis for evaluating the financial performance of the top management, because it is generally the CFO or the CEO or the people at the very top level who are responsible for taking these capital decisions. Cost of capital also helps in formulating the dividend policy as well as the working capital policy. Cost of capital can serve as a capitalization rate, okay, which can be used to determine the capitalization of a new firm. If you are seeing this video for the first time, if you're new to the channel and you like our content, or if you are an existing viewer and you have been seeing our videos and you like our content, consider subscribing if you have not done so far, and hit the bell icon so that you'll be notified anytime a new video is out. We are a community, a channel which focuses on IGNOU MBA mainly, and has videos related to different topics and different subjects throughout the MBA semesters. So do take a look at our other videos as well. The next question in this unit is distinguish between business risk and financial risk, citing a few examples. So, when we talked about risk and uncertainty, risk and returns, trade-offs and stuff, we talked about a lot of different types of risks, right? And in that, business risk and financial risk was also discussed over there. And at that time, in that video also, I had told that this is a very important concept. time and again on in different units we have come across we are coming up across this concept actually of business risk and financial risk. So business risk is what it relates to whether a company can make enough in sales and revenue to cover its expenses and turn a profit. So business risk, in short, is the risk that is associated with the business. Okay, the concern is that the company should be whether the company would be able to function as a profitable enterprise or not. A damage by fire or flood or any other natural disasters, unexpected financial loss due to an economic downturn or a bankruptcy of other businesses that owe you money, or loss of important suppliers or customers, decrease in market share because new competitors or products enter the market are all examples of business risk. Whereas financial risk is a concern that the company may default on its debt payments. So, in business risk, the concern was whether or not you will be able to profit out of your business. And in financial risk, the concern is that whether you will be able to meet your obligations and debt payments on time. The several types of financial risks include credit risk, liquidity risk, operational risk, etc. Now, how would you calculate the cost of preference share capital? In this unit, actually, we have how different methods of calculating the preference share capital, the equity, and like. So, this question talks about how we can calculate the preference share capital. Preference shares are those shares, you must understand, that which have a priority over equity shares in payment of dividends, and also on the proceeds that are realized from the sale of a company's asset in case of liquidation of the company. So preference shares are actually thought of as quasi assets. Okay, why? Because they have the characteristics or the traits of both a debt and an equity. Preference shares are also shares of the company, and the amount of money that you get from sale of these preference shares are equity. Okay, that is the money that you own. Okay, in that way it is, you can think of it as an equity. But the thing with preference shares is that uh, every year or at the end of the period you are supposed to pay them dividends, whether or not your normal other equity holders who are not holding the preference shares, whether they are given a dividend or not doesn't matter. But if there are preference shares holders, then your retained earnings or all the other calculations thereby should come only after paying them the what you can say the agreed upon interest or dividend amount. So dividend, there is no way out than paying dividends to them. Okay, so in that way, that is the reason why. So because of this clause that at the end of every accounting period or at the end of every period where dividends are supposed to be paid, you have to pay them a fixed amount of agreed upon dividend, is the reason why you can think of dividend preference shares as a kind of debt as well. So, and that is the reason why this preference shares are called as quasi assets, okay, or quasi equity. Okay. Now, the cost of this preference share capital represents the rate of return that must be earned on preferred stocks to keep the earnings available to residual stockholders unchanged. Cost of preference shares can be estimated by dividing the dividend stipulated per share by the current market price of the share. So, what it happens over here is that once you introduce preference shares, we told, right, they come with a fixed interest rate or a dividend rate which has to be paid out. So now what happens is that once a share comes in like that, then the earnings that you get, okay, they should also proportionally increase so that you can give your other shareholders the dividend what they used to get, or whatever was promised to them anyways. It's not promised, but you can say the dividend that you usually pay out to your remaining shareholders while also paying out the preference shares. Okay, then naturally accordingly your returns on investment or the returns what you get from your business should increase, right? So that you can still have the same amount of money with you even after paying back your preference share amount. Then that is the cost, that increase that you need, okay, in order to maintain this, that is called the cost of preference capital. It is calculated as dividend minus face value minus issue cost. That is the difference in what you can say, difference in the cost or the revenue. Okay, how would you find the cost of capital for a proprietorship or a partnership firm? Can you think of any ways to do this? So the cost of capital, as we all know, it is the return rate of a company that is earned from its investments in the marketplace to increase its value. This is also the rate that is required by the capital's suppliers for their contribution to the company. The cost of capital can be determined by multiplying the cost of each type of capital by the percentage of that type of capital in the company's balance sheet, right? And adding the products together. The specific cost of each source of the funds is the after tax cost of this financing. So, this is how we would find the cost of capital for a proprietorship or a partnership firm. Now, retained earnings are cost free. So, what are retained earnings? First of all, retained earnings are considered as internal source of long term financing. It is part of the shareholders equity. Okay, generally retained earning is considered as a cost free source of financing because neither the dividend nor interest is payable on this retained profit. Okay, so retained earnings is whatever earnings or whatever portion of the profit after tax that you are keeping back in order to reinvest in the firm. That is retained earnings. Okay, so neither you need, so what dividend will be paid on the amount that is remaining in the profit, okay, after minusing your retained earnings. So you don't have to pay any dividends out of this retained earnings, nor you need to pay any interest to anybody for this retained profit. So you might feel that this is kind of like a cost free capital, right? But it is actually not true. Why? Because if you did not retain that earning, then that also would have gone to your shareholders, and they might have had some other ideas on how to invest that money. And whether or not their ideas on investments could have generated more profit to you as a company than what you would do with these retained earnings is absolutely unknown. It is not known for sure. Okay, so the cost of this retained earning is actually the opportunity cost that comes with it. Okay, so definitely the cost of the shareholders, it costs the retained earnings, definitely cost the shareholders something. Okay, that is the opportunity cost, representing the sacrifice of the dividend income which the shareholders would have otherwise received, and if invested the same elsewhere to earn a return thereon. Thus, the minimum cost of retained earnings is the cost of equity capital. Now, why is cost of equity capital difficult to measure? Discuss the different methods of computing the cost of equity capital. This is an important question. It had come in the June 2022 examination paper. Cost of equity capital is the discount rate which equates the present value of all the expected dividends in future. Okay, it finds out the present value of all the expected dividends that we are expecting in the future with the net proceeds per share or the current market price. Okay, it represents the minimum rate of return that must be earned on the new equity stock financed investment in order to keep the earnings available to the existing residual owners of the firm unchanged. The cost of equity capital by far is the most difficult to measure because it is not the out-of-pocket cost of using the equity capital. It is based upon a stream of future dividends as expected by the shareholders, which is actually kind of very difficult to estimate. We'll be in a, what you can say, in a tough spot if we are to actually estimate future things, because we do not know the level of uncertainty that is involved or associated with future is actually quite tremendous, right? The relationship between the market price and earnings is also actually not, I can say, no. So dividends will also affect the market value, and since these equity shares are traded in the stock exchange, the price differentials are used to compute the cost of equity actually changes due to a variety of reasons. So because of all these things, the cost of equity capital is actually very much difficult to measure. Now, a few methods of computing this cost of equity capital as given in our textbook is the EP ratio, that is the earnings to price ratio, the EP ratio plus the growth rate. Okay, DP is the dividends to price ratio, the DP plus growth rate method, realized yield method, and securities beta method. So these are a few important questions I came across in Unit 5 of our MMPC 14 textbook. If you like the video, consider subscribing, and that's it for this video. See you in the next video. Bye bye.